Hi there, and thank you for tuning in to the very first episode of Only Finance. I'm thrilled to have you here as we embark on this exciting journey together. This podcast is all about breaking down the world of finance in a way that's simple, engaging, and practical. Whether you're just starting out, trying to make sense of your budget, or curious about growing your wealth, you've come to the right place. In each episode, we'll explore topics like saving, investing, understanding markets, and building a solid financial future, all without the complicated jargon. My goal is to make finance approachable and empower you to take charge of your money. Since talking isn't exactly my strongest skill, I've used AI to voice my content, ensuring it's clear and enjoyable for you to listen to. I hope you love the experience as much as I enjoyed creating it. So, grab a cup of coffee, get comfortable, and let's talk finance. My AI friends will take over now.
All right. This time, we're going to be exploring the psychology of investing.
Oh, cool.
Yeah, and how understanding that can actually help you make smarter decisions, right?
Yeah, for sure.
You shared some really interesting material with me on, cognitive biases.
Right.
That can sabotage even the best laid financial plans.
Yeah, definitely.
So are you ready to kind of uncover these hidden forces at play
Absolutely.
in your investment decisions and emerge as a more mindful investor?
Let's unravel those psychological quirks.
Okay, perfect. Let's start with a common one, loss aversion.
Okay.
Think about this. You find a $20 bill just on the sidewalk. Feels
Mhm.
great, right?
It does.
Now imagine losing $20.
Oof.
That stings a bit more, doesn't it?
Yeah. Yeah, it
For
does.
real?
It does.
Oh.
That's loss aversion at play. The pain of a loss outweighs the pleasure of an equivalent gain. And this can make us hold on to losing investments hoping they'll rebound or sell winners prematurely just to lock in like a small profit.
Yeah.
It's like we're so afraid of losing that we forget about the potential for future gains.
Yeah, you're so right. The material you shared mentions the 2008 financial crisis. I remember that.
Yeah.
Everyone was panicking.
Think about it. Fear dominated the market. Investors were selling off assets at rock bottom prices just to avoid further losses.
Yeah.
And they missed out on the eventual market recovery
Right.
because they were so focused on the short-term pain.
That's a tough lesson to learn. So how can we avoid making decisions based on fear like that?
A solid long-term plan is your best defense. Having a clear strategy helps you ride out those turbulent times.
Yeah.
It's about understanding your risk tolerance, setting realistic goals, and diversifying your investments.
Okay, so long-term plan, stick to it. Now let's talk about overconfidence. I bet we've all been there at some point. Bill Gates once said, and this is a great quote, "Success is a lousy teacher. It seduces smart people into thinking they can't lose."
That's a great quote. Overconfidence often stems from past successes.
Yeah.
Investors might start believing they have a knack for picking winners,
Right.
leading them to trade excessively and take unnecessary risks.
Yeah.
But even the most seasoned investors can make mistakes.
Is there a way to gauge if we're being overconfident in our investment approach?
One red flag is frequent trading. A study by Barber and Odine showed that those who trade frequently often earn lower returns compared to those who are more patient.
Wow, interesting.
Yeah. So do you find yourself constantly checking your portfolio, chasing the latest trends?
I mean, maybe.
Maybe it's time to step back
Yeah.
and assess whether those actions are driven by a well thought out strategy or just impulsive behavior.
So patience and a well-defined strategy are key. Now, what about this herd mentality I keep hearing about? It's almost as if we're wired to follow the crowd, even when it comes to investing.
We are social creatures and we tend to seek safety in numbers. But this instinct can lead to bubbles and panic selling in the markets.
Wow.
And it's the fear of missing out, the infamous FOMO that drives this behavior.
I've definitely felt that pull, especially when everyone seems to be making money,
For sure, yeah.
The material you shared used Bitcoin as an example.
Yes.
Do you remember what happened there?
The Bitcoin surge in 2017 was a classic example of this herd mentality.
Yeah.
Many retail investors, fueled by FOMO, jumped on the bandwagon without fully understanding the technology or the risks involved.
Right.
And when the bubble burst, many of those latecomers experienced significant losses.
Oh, ouch. That's a stark reminder to do your own research and not blindly follow the crowd.
Yeah. Definitely.
What's interesting is that this material encourages a contrarian mindset.
Right.
So what is that exactly?
A contrarian investor questions prevailing trends and looks for opportunities that others might be overlooking.
Okay.
It's about going against the grain and challenging popular assumptions.
But isn't there a risk in being too contrarian? Could you miss out on legitimate opportunities by always going against the tide?
That's a valid concern.
Yeah.
Being contrarian doesn't mean blindly opposing every trend.
Right.
It's about being skeptical,
Okay.
doing your due diligence,
Mhm.
and forming your own conclusions based on solid research and analysis.
Got it. Okay, let's move on to another bias. Anchoring. It's about getting fixated on a reference point, like
Wow.
the price you initially paid for a stock, even when that information might be outdated.
Imagine buying a concert ticket for $100, but then realizing it's now selling for $50.
Oh, man.
Anchoring bias might make you hold on to that $100 ticket even though you know it's overvalued.
I see.
This happens with stocks too.
Yeah.
You might cling to a losing investment hoping to get back to even instead of cutting your losses and reallocating your capital.
The source material gave a similar example of a stock bought for $100 that's now at $50 because of issues with the company. It's hard to let go, especially if you've invested a lot of time and energy into researching the company.
Right.
So how do we overcome this anchoring effect?
Well,
What practical steps can we take?
one effective strategy is to regularly reevaluate your portfolio. Ask yourself, if I were starting today, would I buy this investment at its current price? This helps you detach from the past and focus on the present and future prospects.
I like that. That's a great tip. Now let's talk about recency bias. Placing too much emphasis on recent events while neglecting long-term trends.
Right.
It's like having a short-term memory when it comes to investing.
Remember, markets are constantly changing, just like the weather. We can't predict the future based solely on what happened yesterday.
That's a good analogy. It's like thinking that just because it rained yesterday, it's going to rain forever.
Exactly. Recency bias might make you overly optimistic after a market rally or overly pessimistic during a downturn.
Yeah.
Think back to the 2020 pandemic crash and the subsequent recovery.
Oh, yeah.
Investors hesitant to re-enter the market after the crash missed out on one of the fastest recoveries in history because they were so focused on the recent negative events.
Wow, that's crazy. I remember that time well. It was a whirlwind of emotions.
Yeah.
So how do we prevent recency bias from clouding our judgment?
Zooming out and using historical data helps put recent events into perspective.
Yeah.
Markets are cyclical, and what goes down often comes back up.
All right, on to another big one, confirmation bias. We tend to seek out information that confirms our existing beliefs, even if it's not entirely accurate or objective.
We crave validation.
Yeah.
And it can be tempting to surround ourselves with information that reinforces our existing views.
Right.
This can lead to poorly diversified portfolios and missed opportunities.
Henri Bergson said, and I love this quote, "The eye sees only what the mind is prepared to comprehend."
Yeah.
It's as if we're filtering information to fit our own narratives. The material mentioned a tech stock example. What was that all about?
Imagine you're bullish on tech stocks. Confirmation bias might lead you to only read positive analyses,
Right.
while ignoring any warning signs or counterarguments.
Oh.
Then, if the tech sector experiences a downturn, you're left holding overvalued assets.
That's a recipe for disaster. So how can we ensure we're not falling prey to confirmation bias?
Actively seek out diverse perspectives.
Okay.
Don't just read articles that confirm your beliefs.
Yeah.
Challenge yourself to explore opposing viewpoints. You might be surprised by what you learn.
This has been incredibly insightful. So we've explored some common cognitive biases that can sabotage our investment decisions.
Right.
Now let's shift gears a little bit and discover some practical strategies to actually overcome these mental pitfalls.
Yes.
And emerge as more mindful investors.
Knowledge is power, especially when it comes to investing. By understanding these biases, we can develop strategies to mitigate their impact
Okay.
and make more rational decisions.
The material you provided emphasizes the power of checklists. It sounds like a simple but effective tool,
Yeah.
almost like having a roadmap for our investment journey.
Think of a checklist as a structured framework to guide your decisions.
Okay.
It helps you stay focused and avoid impulsive moves driven by emotions. So before making any investment decision, you can consult your checklist
Right.
to ensure that you've considered all the essential factors.
Right. What kind of questions would be on this checklist? I'm imagining things like, does this investment align with my long-term goals?
Exactly.
What are the potential downsides? What could go wrong?
Exactly. You also want to ask yourself, am I being influenced by any biases right now?
Right.
Is this a fear-based decision or a well-reasoned one?
Yeah.
By answering these questions honestly, you bring more objectivity to your decision-making process.
It's like having a wise friend looking over your shoulder, reminding you to stay on track.
Yeah.
The material also highlighted the benefit of automation.
Huh?
This sounds particularly helpful for those of us who might be prone to impulsive trading.
Automating your investments takes the emotion out of the equation. It allows you to stick to a disciplined approach, regardless of market swings or even your own emotional state.
Right.
Robo-advisors and other automated tools can be a great way to implement a consistent investment strategy.
So instead of constantly checking our portfolios and reacting to every market fluctuation, we can set our investments on autopilot and focus on the bigger picture.
Precisely. Automation also frees up your mental energy to focus on other important aspects of your life. It's about finding that balance between being engaged with your finances, but not letting them consume your every thought.
The material you shared also recommended tracking your investment decisions.
Yes.
I've tried this in the past with an investment journal, but haven't been very consistent.
I understand. Keeping a journal requires commitment, but it can be incredibly valuable. Think of it as a feedback loop, allowing you to analyze your past choices, identify patterns, and learn from both your successes and mistakes.
Okay, I'm ready to give it another try. What specifically should I be tracking in my investment journal?
Record everything.
Okay.
The date of each decision, the rationale behind it, your emotional state at the time, and the outcome.
Gotcha.
Over time, you'll start to notice trends. You might discover that you make better decisions when you're calm and collected,
Oh, okay.
or that you're more susceptible to certain biases in particular situations.
That's fascinating. It's like having a personal behavioral analyst,
Yeah,
helping us understand our own investing psychology.
exactly. Once you understand your weaknesses, you can develop strategies to overcome them. For example, if you find yourself chasing hot stocks or succumbing to FOMO, you can implement rules to prevent impulsive decisions.
Yeah.
Maybe you decide to wait 24 hours before making any investment decision. Or you establish a set amount you're willing to invest in any given opportunity.
Okay, that makes sense. It all comes back to self-awareness, doesn't it?
Yeah.
It's about understanding our strengths and weaknesses and developing a strategy that aligns with our individual psychology and financial goals.
Absolutely. And remember that key ingredient we discussed earlier, diversification.
Right. Don't put all your eggs in one basket. But diversification is more than just spreading our investments across different asset classes like stocks, bonds, and real estate, right?
Got it. It also involves diversifying within those asset classes.
Mm-hmm.
So don't just invest in one or two tech stocks. Spread your bets across different sectors and industries within the tech sector. The same principle applies to bonds, real estate, and any other asset class.
So by diversifying both across and within asset classes, we create a more resilient portfolio that's better equipped to withstand market fluctuations.
Yep.
Okay, what other advice does this material offer?
Don't be afraid to seek feedback. Talk to a financial advisor, a trusted friend, or a mentor who has experience in the markets.
That's a great point. It's easy to get caught in our own echo chambers, especially when it comes to investing.
Yeah.
We might need an outside perspective to challenge our assumptions and help us see things more clearly.
Having a sounding board for your ideas can help you identify blind spots in your thinking and avoid costly mistakes. Bouncing ideas off someone else, especially someone with a different perspective, can provide valuable insights and prevent you from letting your biases lead you astray.
Okay, so to recap, we've discussed using checklists to guide our decisions, automating our investments to remove emotion, tracking our choices to identify patterns, diversifying our portfolios to mitigate risk, and seeking feedback to gain a fresh perspective.
That's a solid toolkit for any investor seeking to make more mindful decisions. Remember, investing is as much about mastering your own mind as it is about mastering the markets.
It's that inner game that often determines our success or failure. Warren Buffett once said, "The most important quality for an investor is temperament, not intellect."
Wise words. Even the most intelligent investors can make poor decisions if they let their emotions cloud their judgment.
All right, in the final part of our deep dive, we'll wrap things up with some final thoughts and key takeaways for our listener to ponder as they continue on their investment journey.
Stay tuned for the grand finale.
Welcome back to the final part of our deep dive into the psychology of investing. It's been quite a journey uncovering these cognitive biases and exploring practical strategies to outsmart them.
It has. It's been fascinating to see how our minds can play tricks on us, even when we think, we're being rational.
So, as we wrap up here, what's the key takeaway for a listener as they embark on this journey of becoming more mindful investors?
I think it's remembering that the market is constantly changing.
Right.
It's full of surprises.
Yeah.
And there will be tempting moments to make those impulsive decisions driven by fear or greed.
Like navigating a ship through unpredictable waters, you need a steady hand, a clear mind, and a reliable compass to guide you.
Yeah, and that compass is your investment strategy, informed by a deep understanding of yourself and like those psychological biases we've discussed. You don't have to be a financial wizard to succeed.
Right. More about having the self-awareness to recognize your own biases,
Right.
the discipline to stick to your plan, and the patience to kind of ride out those inevitable market storms.
It's a long game. Just focus on making informed decisions based on sound principles
Yeah.
and avoid letting emotions dictate your actions.
We've talked a lot about temperament being a key factor in successful investing.
Yeah.
It's that inner strength that keeps you grounded amidst the chaos, helps you resist those impulsive reactions,
Right.
and make rational choices, aligned with your long-term goals.
And building that temperament is an ongoing process. It's about, continuous learning, adapting, and refining your approach as you gain more experience. Embrace the journey, and don't be afraid to make adjustments along the way.
Well said. So as we conclude this deep dive, I want to leave our listeners with something to think about. Now that you're armed with this knowledge, what's one step you can take today to become a more mindful investor? Maybe it's creating that investment checklist we discussed, or setting up an automated investment plan.
Perhaps starting that investment journal or reaching out to a trusted advisor for some feedback. The key is to take action and put this knowledge into practice.
Well, thank you for joining us on this exploration into the fascinating world of investing psychology. Remember, knowledge is power, and self-awareness is your secret weapon. Stay tuned for more deep dives into the realms of knowledge that matter most to you. Until next time, happy investing.